It's Brian Preston, the Money Guy.
Braden says, why would I go off of marginal versus effective tax rate when considering a Roth conversion? I'm 29, married, and on step 8 of the financial order of operations. He found the Money Guy show recently and then changed his 401k investing to Roth. So that's from listening to us, I guess. And he loves tax-free growth. What do you guys think?
All right, so there's a few breadcrumbs in there, Brian, that I think are interesting. One, I love whenever we get tax questions because I can just feel the excitement welling up inside of you. For a lot of people, they might not know the difference in like what a marginal tax rate versus an effective tax rate. So I think we ought to level set and kind of talk through that. And then it's interesting, Braden said that he switched his contributions to Roth, which maybe tells me a little about his current tax bracket. But he's also thinking about doing some conversions, and he's trying to figure out if I use marginal or effective. So I think there's some interesting stuff there we can talk about.
Marginal, by the way, because marginals, when you see them, if you go just type in tax rates for the government, we're here in America. By the way, when I was over in Paris for my daughter's graduation trip or whatever, the tour guides did not know we were a progressive tax system over here. I mean, maybe I'm too nerdy that I should not be talking to tour guides while we're looking at all these historical things.
It's wild to me the progressive tax system didn't come up.
But it is. I mean, here in the United States, we have what's called a progressive tax system, meaning that based upon where your income is, the tax rates do go up.
Sure.
And when somebody says marginal tax rate, what they're basically saying is what tax rate are you at within this progressive tax system to where what is your next dollar of income taxed at? And the tippity top of it currently is 37% on the federal level. And then in addition to your federal tax rate, you also have your state income tax rate, because the majority of the states in the United States do have some type of tax on your income. There's a handful that actually are tax-free states, so that makes your calculation a heck of a lot easier. But I would, when we do our analysis of Roth versus traditional, a lot of times we are talking about the marginal rate, and the question is why not use effective, which is essentially what's your average of what you take all your income, and then you figure out what you paid in taxes, and you figure out what your effective rate is. That sounds so much simpler and easier, but what it doesn't tell you is what the decision matrix of is what happens to the next dollar that comes into my possession and my responsibility, so I make the best decision going forward. So that's why we use marginal, because that's going to be at that higher tax rate, so you can figure it out. Because a lot of you might be at the point where, say you're married, say you have a few kiddos running around, you might actually have a 6-figure income, but when you look at all the deductions and everything else that comes in, your effective rate might be like 12%, but your marginal rate might be in the high 20s. We want to make sure that you're making decisions off of what the next dollar does. I hope I explained that well, Bo.
That was exactly right.
So here's what, when you're trying to figure out marginal versus effective and how I make decisions, because it sounds like what I heard from, is it Braden? Braden probably is at a higher income situation, but he loves that tax-free growth. And I hear you. I mean, there's a reason the government limits how much we can put in Roth accounts, and we know the power of compounding growth. I mean, money multiplier. Go to moneyguy.com/resources. Go look at what $1 at your age can become by the time you reach retirement. And you too will get excited if you think about, man, I could be a millionaire, tax-free millionaire, if I'm using Roth accounts correctly. And look, for young people who are in their 20s and 30s, I think, who have that much time on your side, yes, it definitely pushes the scale to favor Roth accounts. But for high income people, you're thinking about, man, is my income going to be higher and lower in retirement? And a lot of people, once you lose your earned income, your actual taxable income goes way down, and you're in a much lower marginal tax rate. That's actually what's going on behind the curtain of our analysis. So that's why we say, yes, if you're in a super high tax rate right now, we're hoping in retirement you're in a lower tax rate. So that's why you might want to, if you're in those higher tax rates, take the deduction right now, because then you'll have opportunities to do Roth conversions or other things in the future to turn it into Roth. But there are a few exceptions, and I'll leave a little bit on there for you, Bo. But for people who are getting older and you're thinking more of the estate planning,
sure,
there are people, we have clients that say, look, taxes, this is not a tax decision anymore. This is more of a legacy decision. And I will say, look, I don't care that you're in the tippity top of of the marginal rates. From an estate planning and a legacy planning standpoint, yeah, let's go ahead and do Roth. But that is so advanced planning that's not something that you should just default to. There needs to be a lot of analysis, a lot of decision making on what the why of this money is. And that's why the work with us always comes in at that point. But that I hope I was just trying to give the mindset we take with the development of these rules, Bo, but also of people might be applying with their money as well.
Yeah, we love tax-free growth. I mean, we talk about it all the time on the show. It's in the financial order of operations. But we don't love tax-free growth at the expense of everything else. And so when I hear you're someone who's able to shift to do either Roth contributions to your 401k or even your Roth IRA, and you're still thinking about conversions, my immediate thought goes to, okay, well, are you at this stage of life? Because I think you said you're young, you're 29 years old. Does it make sense to begin converting assets to Roth if you're already able to build Roth elsewhere? Because what's going to happen is if you're working for an employer and you're getting an employer match, you already have pre-tax dollars that are going to be growing. They're going to be growing. They're going to be growing. It's okay to let money grow tax deferred, especially if you have a mechanism through which you can still contribute to Roth. I see it all the time where people try to do like all Roth as early as possible, no excuses. Maybe that's the right decision. Maybe that's not the right decision. I am a proponent. I just don't like paying taxes, right? I mean, I pay what I'm supposed to. If you're IRS agents, if you're listening, I pay what I'm supposed to. But I try to make very wise decisions that I can minimize my tax responsibility as much as possible. Be careful if you are accelerating too much. There can be some unintended consequences associated with that.